Hey guys, I want to talk about diversification again because I had just mentioned it in my previous video. Um, for me, investing more into the small cap market space, I need more diversification sometimes because, like I said, a lot of these companies they might go bankrupt. Um, a couple years ago, I had invested $8,000, which was a lot for me. That was a significant, uh, and the company basically went to zero. So I was wrong on that one. But if I was right, it could have easily gone to maybe even a million, or not, maybe not a million, but I thought it was worth 100,000. To be honest, I thought, you know, if I'm right, my 8,000 will turn into 100,000. If I'm wrong, it'll turn to zero. Um, and I was willing to make that gamble. But if I had to do it again, I probably would pick 20 or 10 or at least 5 or 4. And so that it comes down to, all right, how sure are you? Like there's some companies, I think there's a good chance that maybe it'll go from $1 to $4 or $1 to $2. And then there's other companies that they might go from 1 to 10 or maybe even 1 to 30. But for me, I think by investing in a lot of the small market caps, that, like I said, some of them might be fraudulent. Some of their information is not correct. Some of them could be fudging the numbers or not being truthful. And if I was a rich investor, I could fly to that country. I could fly, go, have a meeting with the CEO, get a tour of the company, get to know them a little bit. But if I'm just investing on the internet and I'm staying in my house or my apartment or whatever, I can only make decisions based on the information I have at hand. And I'm not saying that I made a poor decision based on the information I had. I thought it was a very good investment. But anyway, I just want to play a couple quick. Some of them aren't quick, but I just want to listen to Warren Buffett talk about diversification.
And I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low cost. Because all they're going to do is own a part of America. And they made a decision that owning part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it, unless they want to bring an intensity to the game.
Like I mentioned VOO, there's the more popular one is SPY. But VOO is the Vanguard one that is the S&P 500 index. That's what Warren Buffett recommends. 90% of your money, 10% of your money into short-term government bonds. And you never got to look at the stock market. You just put in a certain amount of money every month. You just live your life and invest in America, and you think that America is going to do well in the future, and you will do well in the future. But me personally, let's say the S&P 500 can yield 10%. Well, that's been the case historically, but that's not true right now because the market is overvalued, in my opinion. So instead of getting a 10% return, you might be a negative return, or you might only be getting a 2 or 3% return. So I think I can do a lot better than that. I think I can do better than 10%. I think I can get 20 or 30, 40, 50. I think I can do better than 10. And I definitely think I can beat the market. And maybe I'm being stupid, and maybe it's arrogance on my part. But I believe you have to be bold and right. Well, everyone is in this ship, and I'm going to jump ship and go the opposite way. And you have to be able to make up your own mind. I mean, I mentioned Michael Burry. You know, he bet against the housing market, and he made big bets against it. And everybody in the world was against him. So a great investor, a good investor, has to be able to say, hey, everybody else is wrong and I'm right, and you know, even though my decision may not turn around right away, in the next couple years, I'm going to be right. But all right, anyway, I'll let Warren Buffett continue.
To make a decision and start evaluating businesses. But once you're in the business of evaluating businesses, and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't know more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich on their best idea. And omission is way bigger than commission. There's big opportunities.
And I had mentioned that before. I said, you know, you only need about five great businesses to do well. And he said 6 there, but you know, you pick 5, 6 good companies. That's all the diversification you need. You know, you don't need one in the industrial sector and one in real estate and one in chemicals and one in, you know, technology. You know, you don't need 6 Walmarts. Like I said, the richest people in America, most of them, they got rich by owning Walmart. The Waltons. Look up the top 10 richest, you know, or probably top 50 richest families in America, and you'll probably see the Waltons up there.
Mark Hake. I'm from Scottsdale, Arizona, and I'm very interested in your policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable, equitable securities portfolio, and there was one year where you only had 3 in 1987. So I have 2 questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all, it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. we have positions which you don't even see because we only listed the ones above 600 million in the last report, and obviously those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. Sometimes it's because we may be selling the position down even. But so there's nothing magic. We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens.
Diversification is protection against ignorance. There you have it. from the great investor Warren Buffett.
To you, relative to the market, you own everything. There's nothing wrong with that. I mean, that's a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And
so you want to know where to invest $1,000 right now? Well, forget about stocks, real estate.
If you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult. And it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
Buffett, it's great to be here. I've read that there were several times in your investing career when you were confident enough in one idea to put a lot of your money into it. Say,
put at least 75% of your net worth into an idea, aren't you, Charlie?
Well, but 75% of your worth outside Berkshire is never.
Times, I mean, we've seen all kinds of ideas we would have put 75% of our net worth in.
Warren, there have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker. Several times I had 75% of my net worth in one situation. I mean, you really do sometimes in securities see things that are lead pipe cinches. There will be some extraordinary things happen in a lifetime where you can put 75% of your net worth.
But basically what I was just trying to show was, Warren Buffett recommends, for the average person, just buy the index. Just buy the S&P 500 index, just buy ETF. 90%, 10% in short-term government bonds. But for the person that wants an above-average return, and I'll be honest, it's tough to beat the market sometimes. It's very tough. But I believe that, Warren Buffett has said if you're managing a couple $1 million or less, he could guarantee you 50% return. And I don't want to be that bold, but I would like to think that's something that I could do as well. And if you, as far as just the average person, if you got 5 Coca-Colas or 5 businesses like ExxonMobil or something like that, or that's all the diversification you need. If you got 4, 5, 6 of those, you're going to do well. You don't really have to worry about anything. You just dollar cost average every month, and you'll do well. But for me, that I think I'm able to evaluate businesses and find opportunities that some businesses are undervalued, and at some point in the future, those businesses will be worth more, and I could make an above average return on that. So that's kind of like where I'm coming from, my theory. But see, like Warren Buffett, a lot of people have put all their net worth into him. They put all their money into Berkshire Hathaway. And so it's not just his money that he's investing. He basically has to look out for the welfare and the future of millions of families around the world that have basically invested their whole life savings into him, into his decision making. And so when he invests with that in mind as a mindset, not that it's, that he's investing just out of his own personal thing, but he's investing very conservatively, because his number one rule in investing is never lose money, and number two is don't forget rule number one. So, a lot of these people, they want to preserve their wealth and grow it over time. So when he invests, he's investing very conservatively, thinking of all these families that he has been entrusted with their life savings, and I hope that a lot of financial people were the same way. I don't think they are, but where it's not just their money they're thinking about, or how much they can make, but you're also thinking about the risk of all these families that have invested their future into him, and making a wise decision. In one of those clips, basically he said, when and I didn't play this one, but imagine when you graduate high school, you get a punch card, and you can only make 20 investment decisions in your whole lifetime. And what that would cause is people to think very long and hard before any financial decision they make. And a lot of times nowadays is, everyone is looking for the quick buck, and very few people are investing for the long term and really think about it as owning a business. You're buying a business, and well, one of the guys that I had watched, he's not a famous investor, but just listening to him, he sounded like a really good investor, and he's got a really good track record, and I disagree with him a little bit, but because he basically puts 60% into gold, and 40% of the portfolio is stocks. And basically what he tries to do is he tries to find good companies, great companies, and just buy 1 or 2% ownership in those companies. And I'm not sure how many different companies he owns, but it might be 20 or 30 companies, and he might own 1 or 2% of each of those companies, and then has gold in a vault somewhere. So because even money is a promise to pay, is debt, and he wanted the real thing, so he wants the real asset. But anyway, that's diversification, and hearing it from Warren Buffett's mouth himself.